Welcome to Smith Weekly Discussions, an occasional program for our readers and listeners of Smith Weekly Research. Please note this program is a private discussion and everything contained herein is for entertainment and educational purposes only. With that, we hope you're in a comfortable position, along with your favorite beverage, to enjoy the discussion. We remind our audience to examine the show notes attached to each of our shows to better understand how our program functions. Before we get into our discussion, we want to say thanks for questions coming from our audience at Smith Weekly, including Jacob L., the Yellow Cake Advocate, Peter S., at UMEWT1, and Andy J. Scott Sullivan has joined us today. Scott is CEO of Paladin Energy, an Australian-based uranium producer with operations in Namibia, Southwest Africa. Paladin also has a number of various stage projects in Canada and Australia. The company is listed on the Australian Securities Exchange under the symbol PDN and also on the US OTC markets under the symbol PALAF. Scott, welcome to Smith Weekly Discussions.
Hi, Andrew. Good to talk to you again.
Well, Scott, tell us a bit about your background in the mining business before you came to Paladin, and then tell us what attracted you to become the company CEO.
Yeah, so I'm a mining engineer originally with an MBA. My background is pretty broad in terms of commodities and mining companies. So I've got over 30 years of experience, but that's over a range of commodities through my career, bulk, precious and industrial. A mix of domestic experience here in Australia. I've worked in most states here, but also international experience in New Guinea and Canada. When I was working in gold and the US in coal. Previous African experience in Angola and the DRC and Africa in phosphate. My senior positions have been with a few companies. I was the GM of the Wombo Coal Complex with Peabody Energy and BHP. I was the asset president of Energy Coal in Australia. And I've been the CEO and MD of a couple of juniors in coal and phosphate. What attracted me into this role, it was really being presented with a blank canvas with Paladin having recently come out of administration. Still saw lots of potential there. The thought of particularly getting Langer Heinrich back into fighting shape and getting that back into production was particularly attractive to me. But also just the company as a whole, through the last years of its operating life, with capital rationing and the usual kind of cuts that are made, and then going into and out of administration, it really needed to be rebuilt, and that's the kind of challenge that I like. And it's also good to join a commodity at the bottom of the cycle, I guess, which was where I, after I did my research, it's where it looked like it was. So good timing is always a good thing, and it seemed to be that situation for me. So it was a good match, and I was happy to take on the challenge.
Well, let's get into that. What is going on in this uranium market, Scott? And how do you see the inactivity and low prices really lasting from here?
Well, that's a $64 million question. I mean, I try and always take a very high level view of this because I've probably got 12 inches of reports sitting on my desk, and we read them, and as we know, it's hard to get convergence on information in this in this commodity. There's just different views out there. But look, I see the long-term thematic is still strong, and I don't see really any major changes in that. Clearly driven by China's growth, which is now formalized in their energy plan, and that's very, very important, and we need to see that unfold. But I'm also encouraged to see that it's not just about China, and that we've got other countries committed to significant growth in their nuclear industry. India is looking at doubling its number of reactors. They've got 22 now, and they're looking at another 21. Saudi Arabia with 17. So it's always good to see, competition, and I guess a very clear message that nuclear is on the rise in the world, really for countries to be able to meet their emissions targets. So I haven't seen, despite this soft market that we still seem to be in, I haven't really seen any change in that long-term thematic. If anything, the things that I look for out there is the closures, the soft, I guess, base case that you will see some of the industry analysts talk about, where it's a bit flatter over the next few years, is really just the balance between new reactors coming online and the older reactors, retiring. And I think we're starting to see a change there. We're starting to see more and more announcements that those utilities retirements are being deferred. So the US is obviously making announcements currently. We're seeing subsidies come in for some US utilities. We see France change their sentiment to wind back the proportion of nuclear energy in their energy mix. They went from 75 back to 50, and now they're back to 75 again. And have deferred those closures out to 2035. We're seeing the same thing in the UK. India have not really said it publicly, but I've been over to India and I know they've got the same plans. We're seeing certainly a changing sentiment in South Korea, and if there's ever a change of government in Taiwan, I believe most of the opposition are pro-nuclear. So I think we're seeing a changing trend there, and I'm watching that with interest because, from my viewpoint, I think that really will change that kind of softer base case, if you like, that more conservative case over the next 5 years, and growth, depending on which report you read, is somewhere between 0.7 and 1.5% compound average growth rate. So I think that's changing in the short term. 232 obviously has been significant, and we've all spoken about it, on many occasions. But personally, I wasn't expecting a rush back into the market. I wasn't expecting a stampede of utilities to kind of come back in. I thought that we're probably more likely to see just a gradual return to the market over the next 6 to 12 months. There's still some uncertainty. There's no doubt 232 is off the table, and I don't expect that we'll see quotas and tariffs come back in. I think if anything, other options will be pursued, but we've now got to wait till mid-October, Andrew, just to see what Trump comes up with in terms of the full fuel cycle review. I don't hold many concerns about that, to be honest, other than the fact that the uncertainty keeps the utilities out. But I think in the end, there may be some support in there for the domestic suppliers, the domestic producers, but I don't think that'll be quotas or tariffs. It may be something like, directing federally controlled utilities to buy local. I think there's about 8 of those, so you might see kind of £3 million or so of domestic purchases, and that'll be good for them. But look, overall, I think Trump's probably more worried about, it's a big business, foreign investment, $300 billion or so. Russia's building 36 reactors, I think, across a dozen or so countries. So he's missing out on big foreign investment opportunity. But I think politically, he realizes that the US has just fallen behind. And when you're building nuclear power plants for other countries, you create a strategic alliance, or maybe even a strategic reliance, similar to what China have done with the resources industry, for the last decade or so. And I think they're concerned about that. So, a renewed US nuclear industry is a good thing, but we've just got that uncertainty prevailing, and I think we've got to wait until October just to see what comes of it. But I think there was a little bit of news overnight. One does not make a trend, but I think Duke Energy has come into the market for £300,000 a year from 2021, and hopefully that won't be the last. Moving forward, I always think that you've got to be cautious about using the past as an indicator for the future. Whether we see a return to term contracts, on the level we have in the past at 90%, I guess, is an open question for me. Last year it was about 50-50, and I think perhaps we're more likely to see, maybe a greater portion of spot and perhaps mid-term contracts going forward. But ultimately, the security of energy is important for utilities, so we're certainly going to have to see those contracts come back in, and we're just going to have to be a little patient in the short term.
I want to get to Paladin, as there are a number of discussion topics. First, tell those who are unfamiliar about the company.
Yeah, well, just briefly, Paladin is a pure play uranium company. We've got our corporate office in Perth, Western Australia. As you said, we're ASX listed. It's got about a 25-year history to date. It had its public float back in 1994, and that was on the back of the databases from the German parent company's exploration when they explored throughout Australia and around the world. So that was kind of the incentive for starting Paladin. It accumulated resources in the ensuing years through Queensland and Western Australia here, and in Labrador in Canada, and it built two of the first conventional uranium mines the world had seen in many years, in Langer Heinrich and Kayelekera. Yeah, we're a pretty small team these days, apart from our presence in Namibia and Malawi. I mean, we're keeping it pretty lean here. So my direct reports is my CFO, Anna Sudlow. She's new into the company. Michael Drake's my GM of BDM projects. Michael's very important for our future. He's leading the studies and will ultimately help drive the recommissioning of Langer and the operational planning there. I've got my two operational GMs on site, Johan Rue at Langer and Mike Hoey in Kayelekera, and then I've just got my exploration manager who is looking after our exploration assets globally and maintaining those. We're not actively exploring at the moment, and that's a deliberate part of our strategy, just to minimise our cash burn. And we've still got Gary Stoker, who's our marketing and sales manager. He's based in London, so we've still got Gary, not full time, but it's a critical skill set. We want to make sure that we hold on to that. And we've got a small board, so we're lucky enough to still have Rick Crabb as our non-executive chairman. So Rick's pretty well been with the company, I think, for over 21 years. So that's given great continuity, and given that the rest of us are all new, it's great for me as a CEO to have that experience and longevity there. We've got David Reike as an independent NED, background in PwC and corporate reconstruction. Daniel Harris is a good operator. He's ex-Atlas Iron, and he's a vanadium expert. So given that we're looking at vanadium in Langer, that's great a great skill set to have. He's an independent NED, and then we've got John Hodder, who's also a non-executive director, but he's a major shareholder nominee for Tembo, which is our number one shareholder on the registry.
And how about the company structure a little bit more there? How many shares are out? How much cash do you have? And what is your approach to management team compensation during these tough market times?
So we've got 1.75 billion shares on issue, and depending on what the share price of the day is, because it's pretty volatile in the market at the moment, but we're capitalized at about 164 US million. It's about 245 Aussie. We've got 25 cash in the bank, non-restricted, and another 11 that's just restricted at the moment. And our debt really was that bond that was issued coming out of admin. It had a principal of 115 million, and the debt sits at 132 at the moment. So it gives us an EV of around 270. Look, in terms of remuneration in this market, I mean, it's always a challenge, and it's always a compromise between finding the best people that you can, particularly when you're a small team with complex operations, which we are. So, but we've recently done a full REM review, and we put in place a performance management system. So there's a lot of systems that the company either just didn't have, or that probably over the period of wind down and administration that fell away. That's not atypical. So we've gone out, did an independent salary and remuneration review, and look, we pitched things where we think we can attract, a level where we can attract good talent. Certainly the senior people, myself included, we have a large portion of our total remuneration based on short-term incentives, which is about achieving the key and critical goals that we've set ourselves for the year ahead. And we've got a long-term incentive scheme just called SARS, share appreciation rights. It's not quite options, and it's not quite shares. You earn the right to get shares at a future price, but it basically requires significant growth in the share price for those to be worth anything when they hit their milestone dates going forward. And then that incentivizes performance. I mean, our future really is tied around the success of the uranium market, and then ultimately, us converting any increase in prices that we've got into success, principally at Langer, but then driving, growth in the share price through our resource base, which is quite significant.
Now, are there any plans to get the OTC listing in North America upgraded to a QX status, Scott?
No, we've looked at various exchanges. We've looked at other companies that have gone down that path, and look, there's pros and cons. And we've got a significant project in Canada, and I've had a couple of conversations about TXS listings. But at the moment, our preference is just to keep things simple. ASX, we understand it well, and all the reporting requirements and development requirements and legislative requirements. So our plans right now, Andrew, is just to keep things simple. In the future, we keep our options open. Certainly when we try and create value in a different market out of those resources that we've got around the world, it's pretty significant, resource holding that we've got, 370 million pounds attributable. So if we think it's best to float off on a different exchange, then that's an option that we'll keep open. But for now, we have no plans to change our listings.
Very well. As you know, Paladin management has changed over the years since the departure of John Borjov's team in 2015. With your leadership, the current management and board in place, do you believe the company is in a better position, has the required expertise, and is Scott Sullivan at Paladin to stay through the cycle?
Yes, well, look, we certainly are a different company. I mean, when you go through administration and you come out, you expect that, and we really have taken a blank canvas approach here right now. So certainly, it's been a significant financial restructure. So we're in a better place. There's absolutely no doubt. I mean, we left behind $760 million of debt, and we're now sitting at 130. And I don't wake up in the morning, Andrew, worrying about that debt in the right market. When we hit our incentive prices, we will be able to get Langer, particular back into production, and we will have a solution for that debt. Look, I think the significant differences going forward, the previous executive were very, very bullish on uranium, and they weren't probably as interested in term contracts as we will be. I think this executive and the board are going to take more of a conservative approach. We think it's sensible that you underwrite, your restart and particularly payback period with contracts, but also just to de-risk the market going forward. So, we've got our joint venture partners have a contractual right to about 30% of the product, at virtually at spot. So it is a contract, though. We're conscious of that, so we've got exposure to spot through that. The rest, is there for us to play with. So, we've got, perhaps 50% that we can go out and look at term contracts, mid contracts, whatever we think is best. I always think it's probably, a risk strategy where you don't commit all of your production to contracts. So we're probably looking at keeping maybe 20% not contracted, that we would put into the spot market as well. And I think that gives us a good balance, but we certainly will be more conservative going forward. My emphasis is on the site and loading the talent there. We've got an excellent operational team, and the people that we've brought on board to build our study team with, some of those are permanent employees, some of them are from site, some of them are ex-Paladin employees where we thought the skill set was still right for us, and that they were capable of lateral thinking and weren't locked into past paradigms. So we've built that. I think it's a stronger operational team than the company's ever had in the past. And my philosophy will be to, put the talent on the site and run corporate very lean going forward. So, we're trying to build a strong cultural change with the collaboration and involvement of the site. But important for me to look outside the uranium industry for expertise and that kind of unbounded thinking that just brings in inspiration and innovation. And that's certainly paying off. We can talk through the study. There's a lot of very good things happening there. But same name, but I think different company and a different approach. And yes, I came in, being fully aware of where the market was, and I had several meetings with all the directors, and you've got to have faith in the long-term thematic. And certainly our major shareholders said that when they came in knowing full well that it could take a few years for this market to unwind, and that's the time frame and the focus that I came in. So I'm hoping for success, and we might need to be patient for a couple of years for that, but I'm here for the cycle, absolutely.
Okay, and I think you covered a few of these, but I want to ask you, with the rise and fall of Paladin during the last cycle, what lessons about that story stand out to you, and what are you doing differently?
Well, there's a couple of dimensions to that, and firstly, I'm not interested in high capital expansions of the project to create growth or the illusion of growth. My background is firmly in operations and running operations at multiple levels, and our number one priority is to provide a path for Langer back into production. It's still a great asset, but there's a lot that can be done to improve the operation of that asset, and that's what this team is focused on. So, we've inherited a lot of operational issues that are still there despite the two expansions of Langer, and we know they're resolvable. So our focus is firmly on debottlenecking. We're running a very rigorous study process at the moment, and we've identified a lot of options to debottleneck that site as it is, principally as it is, a £5 million operation. And we've got options to spend money on process. They've been around for a while, front-end upgrades in the beneficiation plant or back-end upgrades to reduce costs. They're all there, and we're certainly looking at those. But just in terms of the base operation, we've got over 300 initiatives on the table. We're not going to do them all, and certainly not up front. But these are initiatives that have been identified by people whose experience is really to improve and debottleneck operations, make them more robust and resilient, which is what a lot of my experience is as well. So we've got an excellent team, and it's yielding lots of success in the study at the moment. So that's certainly going to be a major change. And then I think on the corporate side of things, we need to keep our debt under control and certainly underwrite the future with contracts that we can rely on. I'm interested in good returns to shareholders more than I'm interested in trying to keep full exposure to windfall returns, and that's always a compromise. Every company needs to make its own decisions, but we don't want to be starting operations up and shutting them down again a few years later. And Kayelekera was an example of that. So it's not in anyone's interest, and certainly not in shareholders' interest. So I think we'll keep our debt under control, and my philosophy is you earn the right to grow based off the cash flow of your operations, and for us that's Langer. We're gifted with significant resources outside of Langer, and when the time is right to develop those or transact those, we'll certainly look at it. But for number 1, 2, and 3 priority is to get Langer back into operation, get it in at the lowest cost that we can, but make sure that it's robust and resilient through cycles. That's effectively our strategy.
Well, let's move on to Langer Heinrich. As you know, CNNC has partial ownership in the project there. Have they been cooperative as a partner, and do they have any responsibility for ongoing costs, or are they kind of a free ride, silent partner, if you will?
Yeah, although they've been cooperative, they obviously as a representative of a country that's got a voracious appetite for uranium right now, they were not too happy to see it go down onto care and maintenance, and they certainly had a lot of input into that decision. And Paladin had to make some concessions there in terms of funding it when it first came up. So that was a discussion, but in the end, it was amicable and it went into care and maintenance, and that obviously was about preserving shareholder value on Paladin's side of the business, but preserving the resources and asset as well. So they got 25% at the project level. That's important to them. I mean, you can clearly see China's strategy has moved on from just offtake agreements around the world, and they want to be more in control of their production going forward. So Husab, of course, was a big part of that. That's if you believe them, they're operating at about £10 million kind of annual production annualized production. I don't think they'll get there for this year, but they reckon they're at that annualized rate. That's versus, I think it was 14 million pound. And of course, they've just bought Rossing, which is, well, that's good. It's good for Rossing and it's good for Swakopmund and Namibia because it would shut otherwise. So, you know, interesting to see as those contracts drop off, you know, what happens with Rossing going forward. But they've got a strong interest in Namibia, and you know, I think they'd like to see Langer, you know, back into production, you know, at the right price. So yes, they're supportive, and they've, you know, certainly got to fund their way going forward, whether that's you know, on through debt that gets repaid back through the project, or you know, on an equity basis from CNNC. You know, we'll cross that bridge when it comes to it, but they've got to fund their way in the long term, absolutely.
Do you have any insights as to why CNNC did not use their option to acquire Langer Heinrich in the past, when instead they decided to go after assets such as Rossing? What are your thoughts on that?
Well, look, it was pre-me, and you know, I've certainly had that discussion. I mean, you know, they paid 190 odd million for 25% of Langer at the time, and perhaps they thought that was, you know, that it was just too highly valued, and they didn't want to pick it up, and you know, that they had, well, certainly, you know, about 30% of the offtake as it was, and probably we're in a good position to negotiate offtake agreements directly with Paladin going forward. So I can only assume it was a, you know, a valuation issue. You know, whether they've regretted that day or not, we'd have to ask CNNC. But nonetheless, they passed up the opportunity, and you know, we don't have a for sale sign hanging on the door at the moment.
And is there any discussions about adding or selling their interest in Langer Heinrich that you can mention?
No, I mean, we always assume, you know, I think it's always safe to assume that you know, under the right circumstances, they'd probably like to have all of it. But as I said, we don't have a for sale sign on it. Langer Heinrich is our key asset, and it's, you know, it's our growth platform for the company. So we're not in active discussions, you know, with them about selling any more stake. I don't think we need to from a funding perspective. And you know, they haven't come back, certainly in my time, and asked, you know, if there is anything for sale. But you know, as I said, for us, Langer Heinrich being our key asset, you know, it's our platform for growth, coming back into a stronger market.
And how are long-term clients? Have you seen any interest increase related to a potential deal? And with the current Chinese interest in Langer Heinrich, are there any specific clients, Chinese or otherwise, that you are interested in specifically selling material to?
Well, we keep in touch with the market. I mean, one of the I guess differentiating features of Langer is that we were an operator, so we do have those relationships, and we've still, you know, kept our marketing expertise. So we've got Gary Stoker based in London, and Gary talks regularly with our you know, utilities and the people that we've sold to, and also new utilities. So yes, I think every uranium company out there gets a phone call, whether we're interested in, you know, in tendering for a contract, but there's just not a lot of interest around at the moment. You know, the Chinese have been through Australia. I think they've probably knocked on everyone's door just to test, you know, to test the market and see whether there was, you know, any interested offtakes. But these kind of prices, you know, that interest is not really there, and it's not there for us as well. So I guess our focus is just to maintain those relationships, but you know, we're certainly not close to signing up offtakes, you know, at this level in the market. We keep our options open. I guess I've got no preferences. You know, traditional market, you have China and the US and Taiwan. You know, they're all there for us, but you know, we're also talking to other parties to develop relationships going forward. You know, there's probably two ways to approach this market. You can either wait for it to evolve and recover, or you can look within, you know, the clutter out there at the moment and see if there's opportunities for some kind of a, you know, a strategic relationship, and whether that's a bilateral agreement that we're kind of seeing, you know, in the market. There's examples of it out there, whether it's Kazakhstan selling into, you know, to given companies, or whether it's country to country, such as India to Kazakhstan or whatever. There's always other opportunities, and I think we've all got to work hard to try and find what works for our company, and we're certainly doing that. We're not sitting idle, even though it's the early stages of rebuilding this company. We've got a very clear, defined path back into production, and I think really just waiting on the right incentive price. But we're going to be at the start line, ready to go, certainly on where we want to go to for contracts, etc. And we've got our view on where we need prices and probably what our contract mix will be. So we're certainly going to be prepared.
Well, Scott, let's talk about the optimization studies at Langer Heinrich. Is there any desire at this point to expand production capability, or is the focus really on making the existing operation better than it was before?
Yeah, look, our major focus is on making the existing operation better than it was before, but we are paralleling two bodies of work, Andrew. So we've got two feasibilities, pre-feasibilities going at the moment. The first one, and the most important one, is the rapid restart of Langer, principally as it is now, with a nominal £5 million a year operation. And that's lower capital. It's just a quicker path back into production. And if we see, a significant rise in prices in the short term, we just want to be ready to come back into production, and then we'll build our growth off that. Yeah, the second one is looking at some of the historical options that have been there, and the kind of two main focuses there. One is just front end or beneficiation upgrade. That's generally the higher capital one, and that's more centered on the second half of the remaining life of Langer, that kind of second 10 years when we're on low grade stockpiles, because it's about increasing leach feed grade, and where possible, the goal is to keep our production as close as possible to the 5 million pounds that we've enjoyed whilst we're mining out of the open pit. So that's the prime focus of that one. The second half is just continuation of some good optimization work that's been done in the past, and it's really centered on cost reduction. And there's many avenues to that, but one of them is reagent reduction and technology to reduce reagent reduction, or keep closed circuit reagent where we just recover it and reuse it. So there's good ideas there. There's low pressure leaching. There's a whole host of debottlenecking options that we think we can do for relatively low capital, which is very exciting. And looking at vanadium recovery, so there's always been vanadium in this resource. It sits at about a third of the grade of uranium, but it's never been recovered. It's a deleterious element in the product. We've got to take it out through the process, but it's never been recovered. So we've looked at that. We looked at that in the concept study. We're doing a lot of work now in the pre-fees. That's looking pretty exciting. For us, it's an incremental cost. As I said, we've got to take it out of the process stream. So long-term price, $8.50 a pound for vanadium. We're hoping to produce it at a few dollars a pound or less, and it'll be a nice little cash flow earner. But we think that through the debottlenecking work that we're doing as a part of the study, we do think there's some opportunities for some small step changes in production with the existing operation as it is, for not a lot of capital, and that's what we're really focused on. And the goal is maybe another, £500,000, or even if we get half of that, it's still very highly profitable incremental pounds, in the operation as it is. So we're kind of focused on both, to answer your question. Prime focus is on the rapid restart of Langer as it is, but fix it, make it robust and resilient through cycles, lowest cost that we can, but also, progress the work on ways to reduce our costs and keep our throughput up. I don't have a lot of interest, Andrew, in a stage, this kind of a stage 4 expansion that looked to go to 7 or 7.5 million pounds. If that presents itself in the future as being, value accretive, then we'll have a look at it, but it's certainly not our focus now.
Right. And if optimization work goes as planned, can you just give us a rough ballpark figure of what you see as an all-in cost range at Langer Heinrich, assuming some of these initiatives turn out to be good?
Yeah, absolutely. So first of all, we need to recognise that we're 10 years into this mine, and there is absolutely no doubt that we're going to be mining a lower grade in the second half of this mine life than we were in the first, as often is the case in mature mines. But all of our work and all the costs that we kind of talk of now take that into account. So that's just a challenge that we've got to overcome typical challenge for any mature mine. So we're still targeting our costs to be lower than $35 a pound, all-in sustaining costs, despite those lower grades moving forward. And our aspirational cost target is $30 a pound. And certainly we've got the initiatives on the table in the concept study, and as we progress through the pre-feasibility study, and particularly in the first half of the rest of the mine life, the 9 years or so that we're mining out of the pit still, I think that aspirational target is looking very doable at the moment. So that's $30 a pound all in sustaining costs, and that includes those cost reduction initiatives. It includes vanadium credits coming back in, but it also includes some other ideas that we've got. I won't go into all the detail. We've got, as I said, a list of about 300 improvement initiatives. We'll prioritise those. We'll draw a line there, somewhere. We're obviously not going to come in and do all of those. Some of those will be done on the run, but we've got lots of opportunity here just through a good operational approach, having the right external set of eyes from outside the uranium industry. A lot of these ideas are coming, and I'll stress that, but very exciting at the moment. So, that'll put us in a very strong position. An open cut mine with a long life sitting at around, $30 a pound, I think really puts us at the front of the line for operations coming back in an improved market. I mean, there's really probably only us and MacArthur River and maybe Boss in and around those kinds of costs and timeframes to come back into production. So that's pretty exciting. We'll continue with the other work. It'll go through to March, the feasibility work on looking at cost reductions. That'll go through to March next year. We'll wind up the pre-fees for the rapid restart in September this year, and then we'll just go into a short feasibility study for 6 months. So that'll finish about March next year as well. I look forward to making some announcements on that as it proceeds.
With the optimizations, assuming the key optimizations go forward, Scott, can you give the audience a rough ballpark of what you think these optimizations might cost?
Well, we're being conservative and sensible right now. So it's always a compromise. There's a lot of stuff to do. I mean, there is so many initiatives that we've identified that's kind of literally like a bunch of kids in a candy shop at the moment. We're spoiled for choice, but we've got to be practical and pragmatic. So in the concept study, we said that we would look at about $25 million for fix-it capital and some high payback improvement capital. So 25 for both of those. And there's things we simply have to fix. The dryer, for example, is virtually not operational. It runs at it's a very there's a lot of leaks, and it runs at very high temperatures inside the building. It's not comfortable for employees. So we know that we've got to provide a fix for that. They have been challenging in the uranium industry. There's a lot of companies that have struggled with the dryer and the feed prep and the product handling. So we've got some early ideas for that. We're speaking to a range of companies that can give us a solution to that. And there's a few other things that we simply have to fix that capital wasn't put into going forward. So we're looking at 25 million for that. Now, working capital, it's a large mine. Every mine's got to refund themselves back into production. So we're flagging about 55 million US at the moment for working capital. And that's everything that you expect to have to do, to get a large mine back into production. So we've got to mobilise a workforce and carry the cost of those through the execution and commissioning phase. We've got to mobilise equipment back onto site. We've got to restock our inventory and our reagents. We probably need to do some pre-strip in the pits, because I'm sure that the open exposed ore was mined down when they were cutting costs in the last years of operation, and a bit of tails down work. So we estimate at the moment, Andrew, that's about 55 million. So about 80 million US to bring a 5 million pound operation back into production. If you contrast that to starting a new 5 million pound operation, you're looking at about 800 million. So we've got a competitive advantage there. And we think that the time, back into production from when we finished our feasibility study, so we obviously assume that, clearly assuming that we've hit the right incentive price for us, then and ultimately that we've locked away our contracts for so that we can get our project financing in place. We think the execution timeline is 12 to 15 months. And there's some good examples, around the industry of larger operations coming, back into production in that kind of time frame. So we're pretty confident of it.
Yeah, and I was just going to ask you that, so I appreciate you filling us in on that. Do you see Paladin restarting operations as a result of a long-term contract, or due to the spot price recovering sufficiently? And at what uranium price do you see that being initialized?
Yeah, it's a factor of both, because one depends on the other. So at the moment, as we know, in term contracts, I think they're still sitting around $32, and they haven't really moved too much, because there's been very, very little transactions done. They haven't moved as the spot prices moved between $24 and $29. So it really depends on both in the end. If you're fortunate enough to kind of reach some kind of a offtake agreement, that is a win-win for two parties going forward at a premium to the current spot price, then clearly we could start off with a lower spot price. Because we're looking at that combination going forward, as I said, probably about 50% exposure to spot and maybe 50% exposure to contract. And that's just an example. It's the weighted average price that we've got to have and have confidence in moving forward. So you kind of want both. You want to get some term contracts squared away that are at obviously a higher price as possible, but you've still got to have some faith in the forward price curve at spot. If it's going to languish around $25 a pound for the 5 or 6 years ahead, then clearly your term contracts are going to have to be a bit more special than what they've been in the past. So I think we need to have both. We need to have some confidence in the spot price, the forward price curve, and we need to get term contracts signed that of a formula that bring us back into the market, will underwrite our production and our capital payback period, but give us some resilience through cycles. That's what we're looking for. So there's a lot of permutations as to how this can unfold. But the kind of prices we're looking for, we've kind of said that we'd like to see prices around $45 to $50 a pound. We're after a good return to shareholders. That's it. We don't want to waste a resource. We've same sentiment as Cameco on that, and we think the prices are certainly going to move there. I don't need $130 a pound. I would rather see a consistent increase in the prices, and for it to steady out and be, even $50, $60 a pound long-term average price would be fantastic for us. We make great cash at that. Anything above that is really windfall, but that's not something I'm expecting, and certainly not something that we need to get back into production.
Scott, as you know, the company has a good chunk of debt coming due in a couple of years. And it looks like, Langer will have an all-in cost potentially, in that $30 range, as you mentioned. How much pressure exists with the need to get a new low-priced supply deal in an effort to kind of shore up the balance sheet? Or do you feel like you can hold out for some higher prices?
Well, our debt is somewhat off in the future yet. It matures in January 23. So we've got a few years now. We've got a very, very clear path between now and then, Andrew. If there was a solution to that debt, there's covenants on that debt. We've got to. It's not a convertible bond, so we've got to, buy it out or resolve that debt before we come back into production, and that's the way we think of it. But if we get into the $45, $50 and come back into production, as I said before, I'm very confident there's a solution. There's a solution to that debt there. But in the meantime, our strategy is to de-risk the company as much as we can, conserve cash and cash burn. We've done that deliberately. We've reduced our corporate costs down to the minimum. We've got our exploration down to $1.5 million a year. So there's no active program there. That's deliberate. Langer's costs are down to $3.5 million a year for a large mine. And Kayelekera is at $5 million a year, so the sale of Kayelekera was a deliberate part of that strategy, and conserving our cash and de-risking Paladin going forward, and that just helps us, get to that January 23 maturity date. But clearly we're hoping for a stronger price and to bring Langer back into production. I mean, that's the holy grail for us, obviously, and the way that we'll rebuild this company. So I'm a firm believer in the thematic, and it's been a bit slow and a bit soft now, but I'm a firm believer that we'll see those increased prices, by that date. So we don't need to be out there, trying to underwrite with a contract today. There's no immediate urgency. We're doing all the groundwork, but no immediate urgency to underwrite today.
And update us on the Kayelekera sale. How was that going, and what was the reasoning for that sell-off? I think you touched on it, but go ahead and give us an update on that.
Yeah, well, look, it's a deliberate decision, Andrew, and I think whilst we're at the bottom of the market, it's often hard to sell kind of assets at the top of the market if people don't think that there's any kind of blue sky in it for them. But for us, it's quite simple. It is $5 million a year cash burn. We've spent something like $43 million on it since it was put into care and maintenance. And cash is important at the moment, and clearly for us, we have got a far greater return putting our focus, our resources and our cash into Langer, and that's very, very clear. It's apparent that we are not going to fund two operations back into production at the same time. Kayelekera is a higher cost operation than Langer. There would be delay there, but Langer is going to consume our interest and our capital for some time. So if we were carrying it, for another 5 years or so, there's another $25 million cash burn, US dollars in cash burn. So that really stood out as just being value accretive for us. And we had a look at various sale options. In the end, we were presented with one that we thought was the right deal for us. So we stand to save on that care and maintenance cost of $5 million a year. We get $5 million in shares that we've got exposure to, and still in the future success of Kayelekera and Hylea, the entity. We've got a 3.5% future earnings, or through a royalty, if you like, capped at $5 million, and we get our $10 million US bond back over 3 years. To put it one way, by the end of 2022, if this sale settles by the end of the year, we're about $27 million US better off cash-wise on an absolute basis than we otherwise would be, and that's incredibly important to us. So for Hylea, it gives them a principal asset, and I guess that'll be their prime focus. Certainly exploration, they will put money into exploration and also into studies to reduce the costs and to get Kayelekera back into production as early as possible, and that's good for it's good for Malawi, it's good for Hylea and the shareholders, and ultimately I think it's the right decision for us as well.
And at the terms and price announced, do you see that the terms really reflect these market conditions that we're in, or did you see that was really kind of a fair value?
Yeah, no, they reflect where we are. I mean, some resource assets at the moment are attracting no value. I mean, if we look at the value of Paladin at the moment in the market, Andrew, it's principally all on the value of Langer Heinrich. I mean, one analyst put some value against Kayelekera, but our other assets, which normally and in the past have obviously attracted high value, our other resources have virtually no value at these current prices. So it is fair value if you look at the structure of other transactions that have happened in the past. Honeymoon, the purchase of Honeymoon off Uranium 1 and backing that into Boss. They were similarly structured deals where I guess the risk is somewhat shared. It's hard to expect a company coming in taking all the risk. So the way it is structured with the deferred payments, etc., and the royalties, which means it's got to be in production and having sales, and the deferral of the bond over a few years allows the in this case Hylea to come in and get a firm footing to make sure that it's putting the cash that it raises up front not only into meeting those initial purchase requirements, but also into, you know, money in the ground. That's where the value is built. And so far, this has been very well received. I mean, you've looked at the market, you know, Hialeah's shares, you know, went up by 500% or so. There's obviously a small company and highly leveraged to it, but it's been very well received. You know, the funding is that they require is underwritten. There's been a lot of interest in the company and the transaction, and you know, it's a win for us in the long run as well, given what I've explained from a cash flow perspective.
And what about the other Paladin projects? Can you tell us just a bit about those, and are there any near-term plans for these assets?
Yeah, so far, you know, we've got, you know, 320 million pounds kind of outside of Langer and Kayelekera on a 100% basis. So we've got a pretty significant resource holding. It's one of the largest, you know, in the world. Three principal projects for us. In Canada, we've got Michelin, and in Australia, we've got our resources around Mount Isa in Queensland, part of which was the Summit acquisition that we kind of got 100% of last year, and then we've got Meningie and Carly Bore here in Western Australia. So Michelin's located in Labrador. We've got 55% of that at the moment, so that was part of the settlement with Deutsche Bank when we came out of administration. So we kind of handed over 50% of that as part of the settlement of that debt, but we can earn 5% back per year to 75%. So currently we've got 55. We've just earned our first 5% back through just funding the in-ground, you know, holding costs, the yearly holding costs. So we'll get back to 75% in 4 years. That was acquired, you know, back in 2011. It was around a $260 million scrip deal. It's had $75 million spent on in-ground exploration to date. So it's a pretty significant asset, and has had significant focus over the years. I mean, pre-Athabasca it was, and it still is one of the largest resources in North America, 127 million pounds across 6 deposits, and there's still plenty of exploration potential up there. There's reasonably high ground cover in that domain, and good potential for further deposits. It's open at depth. It's open along strike in both directions. Met testing in the past has been great, 90% recovery, conventional acid leaching conditions, supportive government in Newfoundland and Labrador, including the Nunavut government, the Indigenous government, supports regional growth. So it's all looking good, but right now these prices, it's you know, it just doesn't make sense to do any more active exploration or spend money on feasibility. But these projects, you know, attract value very well, you know, as the price goes up, and we certainly look forward to that. And that is one of the ones that we could reinitiate early. We've had interest. In fact, I've had interest in all of these projects, Andrew, and we've had discussions with various companies, but you know, we've got to make the decisions that are right for us. Holding cost of negligible at the moment, and it just doesn't make sense to do transactions now. The Australian projects, you know, up around Mount Isa, well, that was a big acquisition that cost about $1.2 billion in scrip. At the time, there's 3 major projects up in that area across 10 deposits, fairly large resource, 106 million pounds measured and indicated, and 42 million pounds inferred up there. So good relationship with the native title people up there. We've got native title determination and a good working relationship there. But at the moment, you know, the Queensland government doesn't support development. It's a Labor government. Labor government's not really supporting uranium development up here. So, you know, we're just sitting on that one. A change of government is possible up there, and we certainly see here in Australia the current Liberal government is looking at reviewing Australia's, you know, uranium, you know, industry at the moment, from mining all the way through, whether that means, you know, potential nuclear energy or not for us and utilities is a different question. But we certainly hope to see the development opportunities open up. We've got a third of the world's resources sitting in this country, so it just makes sense. Meningie and Carly Bore in Western Australia, they're different assets over here, and these are actually ISR amenable. So even though it's our smallest projects, you know, in our portfolio, we have an internal ranking system that looks at about 10 different elements to rank on, you know, including geology, you know, costs, sovereign risk, all these kinds of things, it actually comes out ranked fairly high. It's a great little project. ISR minimal, as I said, field leach trials were done back in the mid 80s. Potential for 15 to 20 million pounds production over 10 years. It sits adjacent both road and gas infrastructure, runs just past the front and back door, so that's fantastic. 41 million pounds of resources there. So that's a pretty exciting little project. And again, being in WA, though, the government doesn't permit any more projects to be developed outside of the 4 projects that were kind of frozen a while ago. So, we need a change of government, or certainly a change of policy to develop that. But a great project, and one that I think will again attract value as an easily developed project, as the uranium price goes up.
Well, I appreciate the information on the projects and your thoughts on the uranium mining bans there in Queensland and West Australia. And hopefully those do get lifted sometime during this cycle. Scott, let's move on to another question to wrap up here, getting pretty close. Let's say we have an extensive inactive market for uranium and prices stay low until 2022. What is the plan for Paladin if this type of siege was to play out?
Well, we in a way, we're planning for that now. So I think, every executive, Andrew, has got to kind of plan for success and plan for failure, or certainly plan for a market that's not going to recover quick. So in a way, the sale of Kayelekera was really part of that de-risking of Paladin. So you can either say, well, we retain it and we continue to fund it into the future, potentially, looking at incentive prices for Kayelekera without changing its cost structure of north of $70 a pound. So you've got to make a decision about, well, your timing and your faith that you're going to get to those prices and then lock in contracts. So that was part of it, de-risking and reducing our cash flow. So that's very important for us as well. Also getting our exploration spend right down as part of just creating that resilience at the moment. So that has been our main response to a softer market, running a lean team, having critical skills on retainers rather than retaining people full time, and we've managed to do that quite well. So that's our main response. I mean, we've got cash in the bank, we've got our cash burn down as low as we can get it at the moment. We just need to take this year by year and just assess where the market is going. We'll look at those indicators out there, such as the build-out rate in China, and just make our decisions year by year is what we need to do and how we need to adjust our strategy. But we certainly felt that this initial investment in Langer, doing these studies right now, and even though that there's a cost attached to that, that's added value. I think if, I don't believe it's a strategy to kind of lock yourself down, shut the doors and windows and just watch the world go by. You can just see your share price dwindling down if you've got no news flow going back in. But we need to be able to have discussions with the market. We need to be able to have discussions with our shareholders and future shareholders, and we need to be able to have discussions with off-takers and utilities, and to do that we need knowledge of our project. So we're yielding some great progress out of the study. We think it's money well spent, but in the meantime, we'll just reduce our cash burn down as low as practical.
Scott, I'm sure we have at least a few potential investors listening that are considering Paladin. Why should potential investors be considering the company now? What would you say to potential investors who are listening?
Well, Paladin sits in a really unique position here. We're one of the few relatively production-ready operations waiting to come back into production. As I mentioned, MacArthur River, probably Boss and ourselves sit reasonably there, although we've possibly got slightly different cost structures going forward. But post our studies, so as of March next year, we'll have a very, very clear path back into production. We can articulate it now, but we'll have even greater certainty, obviously, when we finish our feasibility study. So we've got low capital, Andrew, back into production. So we mentioned about $80 million US to get the base case operation back in and a robust operation back in for a +5 million pound a year operation. You compared to bringing a new project online now, you're looking at about 800 million, plus or minus for a similar sized operation. we'll have low operating costs, as I mentioned, less than $35 a pound and likely closer to $30 a pound. New production, the incentive price for new production, anywhere from $60 to $80 a pound. I think most of them will be closer to $80 a pound. So we're in a great position from a cost point of view as well. We've got pretty fast startup, and this is where we're really differentiated. When we are an existing operation, we've got steel and concrete in the ground, we've got all of our permits in place, so you don't have that risk and exposure with us. So we're looking at 12 to 15 months once we reach the right incentive price, and we've got our funding, finance organised. 12 to 15 months back into production to execute this, compared with 3 to 4 years for a new operation at best. The larger operations, you're still looking at 5 to 7 years. We're a known product. We've got existing market relationships out there. That's also very important. It's often a lot of hurdles in getting your product out to market. So we've already done that, and we maintain those relationships with utilities. That differentiates us as well. And I guess from an investment point of view, when you look at our EV per pound valuation, it just sits pretty low at the moment, maybe as a result of the kind of cautiousness with a company that's come out of administration in the past. But if you have a look at us as a fresh investment, we're sitting at a reasonably low EV per pound valuation compared to our peers. We're about 15% of Cameco, and we've got 40% of Cameco's resources. We're at about 35% of the Athabasca projects. We've got a much simpler register, and we're quicker back into production with higher certainty. So I think there's high leverage there compared to where our current valuation is, and it makes for a very good investment prospect. So I guess that would be the factors that differentiate us and what makes us a good investment option for anyone that's looking to come into the uranium market.
And how can people reach out to the company for more information?
Well, certainly you can reach out directly to us. I'm talking to funds every week. Myself or Anna Sudlow, my CFO. We've got our website. We've got a brand new website out there. It's a lot simpler and presents some great information, so you can get in touch with us through that, or any of the Australian brokers that are dealing in our stock. Euros is very active in our stock. But if you wish to know anything more, by all means, touch base with myself directly.
Scott, I really appreciate you coming on and sharing your time with us. It's been a pleasure.
No, it's been an absolute pleasure for me, Andrew, and thanks for the discussion. It's a fascinating market at the moment, and I look forward to Paladin being a significant part of that market again going forward.